What's up, everyone? Here with David Giustizia. Lucky enough to have him in the studio with us. David's been in residential, commercial mortgage, mortgage broker, mortgage brokering, all of that thing, consulting, CFP as well, right?
Yep, you got it.
Since 2015, I know he's been doing the mortgage. How long have you been doing the CFP thing? Just as long?
Yeah, about the same. Yeah.
We're lucky enough to have him here in the studio with us. We're going to talk a little bit about what's going on out there this week in real estate. Some headlines happening as we see changes in the housing market. Things are shifting. Things are changing up. I was just reading the Financial Post just yesterday, actually. Article headline: Canadians' love affair with variable mortgages is coming to an end. And they're talking about how there's a lot of interest that they're seeing now. Talking with one of the large rate websites out there, and they're seeing a lot of interest now coming from short-term fixed rates, as well as expected, an extremely high increase in people looking at fixed rate terms again, and everyone's done with variable. What are you seeing out there?
Yeah, that's such a valid point. I mean, looking back, I don't know, 7, 8 years, like variable has been a kind of a fluctuating interest, I think. And a lot of it came from, we saw a lot of fixed mortgages in the past. In the old, I don't know how many people watching this have been in real estate that long, but prior to the stress test that was introduced in 2017, there actually still was a stress test, but only if you took a variable, right? And so back then, fixed became very popular. There wasn't a ton of rate volatility. People were able to qualify for more with fixed because they weren't stress tested. And so there was a high percentage of people going into fixed. Jump through 2017, all of a sudden now stress test applies to everything, right? And then as we kind of went, especially into the COVID times, we saw this massive transition into variable, and even a little bit before that. Now, I think with the variable mortgages, like I'm a huge proponent of variable mortgages, always have been. But I think the biggest challenge that we see, or the biggest thing that we see from people right now, is just this: the variable mortgages have pushed to a level that is just kind of crazy within the time frame, right?
Mm-hmm.
Like, what we saw from Bank of Canada last year was just insanely aggressive.
Yeah.
And I think what's driving a lot of this discussion is that because of what's happened in the markets, because of some of the bank failures that we've seen, because of future expectation of rate decreases, the fixed mortgages have come down considerably. And so now in pretty much every case, you have to pay a huge premium to go variable. And I think for a lot of people, rightfully or wrongfully so, a lot of people make their decision based on what's the cheapest rate.
Yeah.
Right. So when we look
short term, what's the cheapest rate? Not long term, right?
Well, exactly.
What's the cheapest right now today?
Exactly. Like if I look at the rates on my plate, like what is the cheapest rate? And so I think, when we got into this COVID situation when we were issuing variable mortgages at like low 1% range, obviously the Bank of Canada at that time put a lot of commentary forward, especially that like the comment that gets quoted, time and time again, that, hey, we're going to hold rates low for a long period of time. Right. So I think the combination of it's the cheapest option on the sheet, combined with this guidance directly from our central bank that says we are going to hold rates low for an extended period of time, made a lot of people, and brokers included, and other mortgage professionals included, really comfortable on recommending variables.
Now,
right?
you talk to a lot of different people, a lot of investors, a lot of different people in the industry, and all sorts of facets of it. Is anyone, especially after the pandemic we just had, is anyone actually giving merit to what the Bank of Canada is saying out there anymore? And especially when they're talking about what they are or not going to do with rates?
Yeah, a little bit. I think like the more recent commentary, so we've seen a couple really recent updates from the Bank of Canada that I think are helping gain. I think what they've realized is they need to get consumer confidence back. Right? The huge misstep by them kind of projecting into the future. They changed the decision based on things that, they couldn't control and had to move rates to control with the inflation that we saw happen at the end of 21. And so Bank of Canada, one of the big things that they're starting to do this year is they're coming up and making public some of the rationale behind their rate decisions, right? So this is something very new. They're going to start not just on those 8 times a year that they come out and make a decision on their policy rate, and the 4 times a year that they add a little bit of additional macroeconomic clarity. They're actually going to come out and provide a more detailed, in-depth understanding out to the public as to how and why did we make the decision we made,
Yeah.
right?
Yeah.
So I think that's a decent first step
Yeah.
for them to say like, okay, we're going to start actually giving some rationale, not just here's our
Yeah.
final decision, take it as gospel. I think the other big thing, like to your ask about, do people really care what they say anymore, is that they've also been really clear about their past mistakes,
Yeah.
right? They've come out and said, hey, like, we're going to stay away from effectively making promises on things we don't control, right? We're going to stop predicting with a degree of certainty, that the same degree of certainty that they put out during the pandemic to say like this will happen. Now the updates that we're seeing are comments about like, well, if X happens, then we'll do this, right?
Yeah.
If inflation continues on its downward track, we will consider starting to bring down the policy rates, as opposed to we're going to start bringing down policy rates by this time or by this time.
Yeah.
They're now kind of creating these like conditional commentaries.
And that's a beautiful thing for a lot of people. I feel really bad for the average homeowner. So the person that isn't investing or anything like that, that is now at that point where they took a lot of merit in what, in what the bank was saying and everything like that. And maybe this was the best decision, maybe it wasn't the smartest decision, but they didn't do the kind of financial analysis and kind of doomsday approach that someone such as yourself or many of your clients, someone such as myself, would do when looking at these things. So they were left holding the bag, and there is no going back now. So it's nice of them to say going forward, oh, we're going to do better going forward, but those people are screwed. But I do think there was a bit of a not the smartest way of looking at things from a lot of investors specifically. So now I'm hearing a lot of investors, complaining about where rates went, and they've got all these properties, they've got JVs that they're losing money on. Interest rates went through the roof and everything, and I wonder. I want to say there's needs to be a bit of accountability, I think, with some of those people as well, because looking at the fact that rates were down, like what they were down into the ones at some point.
Yeah,
If you're an investor, you should have a better understanding of money markets and the way that money works, that that isn't going to be sustainable. So making big bets on that and then expecting that, I don't know, like where does that accountability lie at that point? Because you're hearing a lot of people now, oh, what am I supposed to do? I just saw some guys talk about this. The Burr model is dead. Just you can't Burr anymore. That's dead. That's over and done with, which I disagree with as well, because of interest rates and what's occurred with them.
I think there's a couple things. I think, like, to your point around stress testing and analysis, there's, a certain set of assumptions that I think everybody gets comfortable with, right? And it comes down to time. So if we look again historically, right, like, okay, sure, the 1%, 1.5%, the high one fix, we're doing refis at 179, 189 at a time. It seems insane to talk about now, right?
Yeah.
And like, I think the big thing with that is nobody was prepared for rates to go this far. Like, I think back to when I got the first mortgage on the house I currently live in, right? I got that at 2.34 on a 5-year fix,
Wow,
and that was
yeah.
back in 2016.
Oh, okay.
Right? So like, rates popped a little in 2017, 18, and then clawed back and forth. But I think like people kind of got comfortable with it's a bit of a good deal, maybe a little bit too good, but maybe we're stress testing at 2.5, maybe we're stress testing at 3. I think the worst I saw is like we peaked, some of the lenders were peaking out in high 3s, low 4s during 2018. And so I think for a lot of people, that's kind of the band that they remember. So they're looking back 10 years and saying, okay, well, yeah, they're this good. Nobody, 2 years ago, 3 years ago was running 6.7% rates in their model, right?
Yeah.
Like, we're seeing Scotiabank's been very public right now of the fact that they don't want to be competitive.
What are they saying?
Basically saying we don't want to be competitive in the mortgage market. So we are going to be out of line on pricing, right? And that's the easiest way for a bank to determine how much mortgage volume they drive is their rate, right? You want to drive a ton of new volume, you're going to drop your pants and
price
you're
the
going to
product.
price the product, right? If you want to reduce your origination channel, you're going to be out of market. So like, we're seeing like rental mortgage variables from Scotiabank right now in our channel are prime plus 0.4, which means 7.1% for a Scotiabank rental variable today.
Really?
Yeah.
Wow.
And they're being really really open about it. But it's really important. Like, we have so many clients right now that we're working on from Scotia. And I love Scotia. I love their product. They're worked there for a number of years. One of my favorite lenders to work with. But apples to apples in terms of similar products, similar mortgage sizes, similar client, there's lenders that are anywhere from 1% to 1.5% cheaper than Scotia on rate.
So why does someone pick a Scotia then at that higher rate over that? Other than the only thing I can think of is security in their business model. Like I hear that and I go, okay, they're making sure their numbers make sense at the end of the year.
Yeah. So, I mean, why would somebody pick Scotia right now? Scotia went from being one of our biggest lending providers
Mm.
to we do almost no business with them at this point.
So
Again,
no one
because
picks Scotia.
nobody picks Scotia anymore. Now, some people do it out of necessity. Scotia's still one of the most lenient rental lenders,
Okay.
right? The problem, not a problem, but the challenge that's coming up, right, is because Scotia was once upon a time reasonably competitive on rate. They were usually never bottom of the pack, but they had fair rates. And they were also very lenient on rental underwriting. And investors really favored variable mortgages. You have these investors that have massive amounts of mortgages with Scotiabank. And now because of where the rates are, they can't qualify elsewhere, right? And, I'm not saying Scotia's doing this intentionally, but it creates a bit of a trap because some of these mortgages are coming up for renewal, right? They're not in a position to take their business elsewhere. So they're effectively stuck either disposing of the property or taking whatever offer their current lender provides. And this is something that has become, I'll say, a newer focus of our business and our decision making for clients is like, how fair has this lender been historically on renewals, right? If we have a potential expectation that you may not qualify to switch in the future, right? Your mortgage comes up for renewal. Typically what we do, we go shop the market. Who's got the best deal? Is it with your current lender? Is there maybe a better option out there? Now it's like, hey, there's a chance that when this mortgage comes up, you don't qualify. So let's make sure if we're placing you with a lender today, it's with a lender that historically has stayed mid-market, right? They don't have to be the bottom of the sheet. They don't have to, they never, the top of the sheet. And it's like, you're always going to get a good, fair renewal option. And this is something that like has not, historically speaking, been like a huge important part of the business.
Yeah. All right, just caveat here because I have my personal and business with Scotia. David does a lot, but we love you, Scotia. You guys are great.
Absolutely.
Just want to be clear here, so we see that. Okay,
Yeah.
just don't want any issues with that later. Funds declined at the ATM. There, talk about us. No, but it's a lot of craziness going on out there. I've been like I said already. I do feel bad for those people that are getting pinched, but then I start reading about these things where mortgage defaults aren't happening. Like people, that stress test that occurred for your average household, they're saying, I think they're not even seeing a high number of mortgage defaults still at this point. And now with the Bank of Canada rate pause, I think some people are feeling a little better as we're seeing from housing market. Right. And the housing market and the prices. And we're seeing, what was it, since January, I got this stat somewhere here where prices are up 17% since January. We're up 11% month over month right now.
Yeah, it's insane.
Things are starting to pick back. It's like everyone with money didn't disappear.
It's just gone crazy, right? Like we've seen even in the last couple of months, like the number of properties going into competing offers, the number of properties with double-digit competing offers have just gone insane. And I think like that's made a huge impact, that sentiment, that comfort level around Bank of Canada saying what they've said, which is funny because now there's some talk that with, the way inflation's been moving, the way housing prices have been moving, maybe that pause isn't ultimately going to be a pause.
Well, that's what we're seeing, right? We're seeing a lot of that in the news recently. People are starting to talk about could this delay the Bank of Canada that said that they're going to look at rates at the end of the year? Could this delay Bank of Canada dropping rates? And some have even gone as far to say that if housing prices are rebounding as quickly as they are, maybe this shouldn't be the end of those rate hikes.
And that, I think that's a big discussion point right now. And I think just to quickly step back to your comment about defaults, because I think this is important. Like the Canadian economy, like even if you look back to 2008, right? Comparing what happened in our market to the US market, it was night and day. We did have a drop, but not nearly to the extent. And I think like Canadians are very resilient in the sense that they will cut everywhere else to not lose their house. Yeah. Right. Like it's very much a situation of last resort. And so even though we aren't seeing the spike in defaults, I'm definitely having lots of discussions with lots of people. I have clients that have picked up second jobs to afford their house. So they're feeling the pinch. They're definitely feeling it, but it's not translating into defaults. The only defaults that I've really seen, to be honest, are people that were ultimately over leveraged, right? I'm seeing more defaults in the investor space, people making bets on flips, people using expensive private money. Your average homeowner, I actually don't have any in our book through all of this that have gone into a default situation.
Mm-hmm.
But you're absolutely right. Like this idea that Bank of Canada might again change gears is very possible. And I'm not going to sit here and predict what I think they're going to do, but I think it's important that Bank of Canada has been really clear, and it's important for everybody to understand this, that Bank of Canada is going to respond to macroeconomic factors,
Yeah.
right? So what they think in February and what they think in May, based on the changes in the economy during that time period,
Yeah.
it may differ,
Yeah.
right? And I think this, again, large outcome from that kind of misstep that they made around kind of suggesting that these low rates were here to stay for a long time. It's now, hey, yeah, maybe if things change, if housing prices spike, maybe there is another rate hike to come. It's hard to say.
It's an interesting place to be in right now, because I know quite a few different investors that have been sitting there going like, okay, like, you know what, I can probably hold out till end of year. There'll be one more drop. I'll have a good look at the fixed market at that point. Maybe they're playing that game. But then you start to hear these things. It's like, well, what do you do as an investor to make that decision? Especially when you factor in that Stats Canada was just releasing that a significant driver of inflation in the last month was actually mortgage interest rates and rental rates as well. So like all the things the Bank of Canada has been doing to try and taper inflation, and now we've gone full circle. And I guess it begs a few questions. One of those questions is, have we hit the bottom of the floor on the housing market? Like, have we hit that bottom? Are things looking up? And from what you're saying, I'm sounding like, yeah, probably.
Yeah, I think it's a hard thing to predict, because I think it is like, so this is off topic, but I'm going to go there anyway. I was presenting to a group of realtors today, and we were doing some mortgage educational content with them. And it was very interesting. I'm remembering a few of these numbers off the cuff, but I was running amortization schedules. And so what we were looking at is just examples of like how paying your mortgage biweekly versus monthly can help you pay it down faster. How much difference putting a little bit extra on your payment or doing a little bit of annual lump sum makes, or how much interest you save by doing a 25-year mortgage instead of a 30-year mortgage. All these types of little, just when you tweak your payment, how it works. And it was really interesting to see. So we ran a 500. So this was kind of our base case: $500,000 mortgage, 30-year amortization, 5% rate, right? So that was kind of our line in the sand. So assuming that rate endured for the entire 30 years, which is kind of not a realistic assumption, but
Yep.
to model it out, you would have ended up paying $460,000 of interest over the time that you paid off that $500,000 mortgage. So by the time that's done, you've effectively paid $960,000 to pay that $500K, right? We ran the same model at a 2% rate, and I'm struggling to come up with the exact number here, but I believe the total interest was definitely under 200,000. I think it was maybe like 140,000. But anyway, it was like close to a $300,000 interest gap.
Significant.
Yeah,
Yeah.
like huge.
Yeah.
Right. And so, when we look at how that impacts some of the stuff you're talking about, right, it's important to understand, although not a lot of people internalize it, how sensitive our housing market is to interest rates, right? Like that cost of that house effectively in a world where we have a 5% mortgage versus a 2% mortgage, the cost of that property changed by $300K over the life of that loan. And so I think it's really going to depend on where Bank of Canada goes, right? One of the big drivers, in my opinion, of what we've seen in housing in the last 6 to 8 weeks is two things. Number one, back to a little bit more conventional fundamentals in real estate, right? Being that like the spring market is a hot market.
Yeah.
That hasn't been the case for the last couple of years. We haven't seen these like seasonal adjustments.
Well, seasonality was at, I think, almost every industry during the pandemic. It just disappeared. You
Exactly.
couldn't predict what was occurring, and that's why havoc
Exactly.
occurred
It was
across
just all
markets.
over the place,
Yeah.
right? And so we've seen that, but I think the other big thing, and I think this is really important for people to understand, you mentioned about that investor who's going to kind of like ride it out to the end of the year and see what happens with rates. The fixed rates where the bonds are today are pricing in a very substantial amount of rate drops over that 5-year period.
Okay.
Right. And so, what this is doing is we're seeing like high ratio purchases. So new first time home buyers putting less than 20% down. Those rates are now down to like 4.4, 4.5, 4.6. Right. And so there's this kind of sentiment that it's like, well, I don't actually have to wait because the fixed mortgages are pricing in this expectation.
Okay.
And so people are saying, well, I'm just going to go fixed
Mhm.
because regardless of whether or not that actually occurs, I'm basically getting that benefit today.
Yeah.
Right. And I think this is where there's really an opportunity for it to go two ways. If signals start coming that rates are not going to move down the way that some people anticipate, then not only might that stifle a little bit of the housing market, what that's going to do is it's very likely going to increase the bond yields,
Okay.
right? Because those bonds are pricing in this future
Yeah.
expectation. So if that sentiment changes, we may see fixed mortgage rates go back up.
So it's almost time to and you know what? Is it, I feel like the narrative gets very skewed when we have these conversations. Like, and I think we've had this conversation before. 4.5 points is not a bad price to borrow money. Like,
No.
historically speaking,
Not
it's
at
a
all.
good place to be. Like, a lot of people, oh man, I'm only going to get a 4.5%. And it's like, yeah, you're borrowing
Yeah.
a chunk of money. Someone's going to
Yeah.
get paid for it. Like, most people are happy to borrow most of the money. How much consumer debt that they take at 20 points regularly. They'll spend 20 points on everything else in their life. And then they get to a house and they want 1.8% and think that that's sustainable. So,
Well, that's it. I mean, if you're in a world where borrowing, I mean, we were doing rates at one point during COVID at like 1.2%, right? And to translate that into like something that the average person can internalize, that would mean that your borrowing cost on $1 million is $1,000 a month.
Wow.
Like, that's insanely
Yeah.
low. Like,
Yeah.
that's stupid low,
Yeah.
right? So I mean, yeah, like where the rates are, and I think this is what's driving a lot of confidence. Is we've kind of got back to, it's like, okay, it's a rate people can afford, it's a rate they're comfortable with.
Mhm.
So, if they can afford the payment, they know they get this for 5 years. They know that hopefully in 5 years it's going to be maybe not better, but certainly hopefully not worse.
Mhm.
So they're pulling the trigger.
Yeah.
Right. And that, I think that's a lot of what we're seeing right now is just this, like, I can afford it today with a rate that I'm guaranteed for 5 years and I'm comfortable with it. So I'm going to move forward.
And I think you're right. You talked about it earlier. And I've read about it and seen it as well, that Canadians are good at adjusting the rest of their spending to ensure that housing and their costs towards housing is taken care of in any which way. And I think, now that things are a little bit more steady, people have adjusted, maybe they went from 2 vehicles down to 1 or whatever it might be. They're not, I know in our house, cable got cut. We cut a few different things just because we said everything's going through the roof. We're like, we need to look at everything we're doing, in every which way, just to wherever we can save. So, I think that confidence is coming back, and we've seen that in the market in this last little bit. And I expect to say, you're right. I've been seeing a lot of bidding. I've been throwing in some deals on things. Oh yeah, they've already got 2 offers. They're at asking. They want to go over things like that. I'm like, already, things have just changed. And it's funny because I think a month or two ago, you heard people talking, well, is the spring market going to come in, and how's it going to come in, and how are things going to go? And I'm like, okay, we're right back to where we were. It almost feels like the start of something crazy again.
Absolutely. And I think the other thing that's a little different this time, which is kind of cool, and I think it plays into like the analytics of the investors that are really focusing in on really dialing in their analysis, is we've also come back to a geographically focused price movement.
Okay.
Right. So like what we saw during COVID was that like everything just went insane. Right.
Yeah.
It didn't matter whether you were in Sudbury or downtown Toronto or Hamilton, Burlington, or out in Windsor. Like everything was just kind of floating up altogether. Right. And now what we've seen with this flush of activity is that it's not every market that's getting this right now.
As it should be.
Right?
Like not every
exactly,
market.
right? The fundamentals are not the same across the board. So what we're seeing is, again, back to like a little bit of a normalcy. Like the KW market right now has been really, really, really hot. More so than, say, like some of the other markets like Brantford and some of these other markets. And so it really just comes down to, like, we're back to a state of, like, I don't want to say traditional market, but a little bit more of a traditional market, right? There's seasonality to the market. There's certain pockets that are outperforming other pockets. And it's really interesting to see so many people that got into the investment space during COVID haven't experienced that before. Right? Because there's a lot of people where like their memory of investing has just been through this crazy.
Everything's up. Everything's down 30% every month. Everything's great.
Exactly.
Kenora, Ontario, 60% growth. Through the roof. Yeah.
Exactly right.
It's done.
I think it's burning people, a lot of people that haven't spent enough time in the market to really understand the fundamentals of what they're buying and what it's worth.
That's the trick, right? Not enough time in the, but history, folks. There's history lessons, there's graphs, there's charts, there's lots of things out there that you can look at. I know the rate hikes was something new. I think Canadians could never predicted that the Bank of Canada was going to increase rates at that speed in which they did. I think everyone expected it was going to happen. So maybe that's not new. So don't blow up the comment section with I'm an asshole. But at the end of the day, is now. So here's the dying burning question: is now a good time to get in a new mortgage product? And what I mean by that is whether that's refinance your investment property, pull the trigger on buying that home, whatever it might be. And I know, there's lots of other things and we can't hold you to it. So if you listen to the advice and you take it and then you feel burned, that's your fault, not his. But
yeah, disclaimer.
Disclaimer.
Yeah, I think, and this is kind of how I've always felt, no matter what market we're in, is there's no good answer to that question.
Yeah.
Right? Like everything that we do, and I talked about this a lot back in my financial planning days, did some presenting to different groups and things like that. Is like when it comes to financial planning, of which, that type of decision to me kind of rolls into the financial planning piece, right? It's like, how does this affect the overall plan? How does making this decision of buying a house or refinancing an investment property or converting from variable to fixed, like what's the big implication here? It's very individualistic advice, right? So I can throw out some kind of blanket thoughts on certain pieces and certain groups of people that may benefit from certain types of things.
Mm-hmm.
But ultimately, everybody's situation is going to be somewhat different. And I think one of the things that Canadians, to a degree, lost sight of is like there's other reasons to choose between variable and fixed outside of over that 5-year period, which one am I going to pay less interest in,
Mm-hmm.
right? And so there's a whole bunch of other decision-making processes here. So I think for those that are kind of getting into the market, home buyers, average homeowners, I think the two big things for me are, number one, is it a good time to buy? Who knows if we're going to see another dip? Who knows if this is just a bit of a bounce and then it's going to fall off a cliff? But I do think we did see a very large correction last year. We're starting to see the reversion. Even if we start to plateau, we're not seeing building costs get any better. I'm not seeing the labor market for construction get any better. We're not seeing the new home starts. So I mean, this is, and I know this is talked about like an insane amount, so I'm not going to go too deep, but like just this idea between the immigration and the new population that's coming into Ontario and the need for housing versus the availability of housing is just not on balance, right?
Yeah.
And so if you can afford it, if you have a rate that makes sense, if the payments are affordable for you and your family, like there's a lot of people that I've worked with over the past 6 months that have said, yeah, like I do want to convert from variable to fixed. Maybe I'm not better off at the end. We can see how the 5 years plays out. Maybe I am, but it's a payment I'm comfortable with. It lets me have a lifestyle that I'm happy with. So, I'll run the risk that maybe I would have been better off sticking it out, but this gives me some level of certainty that for the next 5 years, 3 years, whatever, this is my play, right?
Yeah. So when talking about rates, just quickly for those that are wondering, those investors that are looking to model rates, it's May 16th, 2023 today. If you're looking to model a rental residential kind of rate, nothing that's commercial or whatever, what should we be looking at putting in there?
Yeah, great question. I think for the fixed rates right now, I'm seeing some options as low as the high fours.
Okay.
But again, it's somewhat lender dependent.
Yeah.
Right. So it's like, who can you qualify with? And one of the things that, again, the banks don't come out and talk about this, but I gotta believe that deep down they know it. They know their space. They know when they're a more lenient lender or a tighter lender, right?
They know more than all of us know.
Yeah,
they pull the strings.
Yeah,
and we
exactly.
dance the marionette.
Puppeteers, right? So it also depends on who you can qualify with.
Yeah.
Right? Are you kind of a AAA applicant with a great income to debt ratio and you can qualify at any lender? If that's the situation you're in, then a high fours is attainable.
Okay.
If you're going to be a little bit tighter on qualifying, if you're a little bit more of a tricky case, somebody with a bigger portfolio, maybe not as much employment income, whatever, might be higher than that. Scotia right now on their 5-year fixed for a rental for us is 629.
Okay.
Right. So there's a bit of a band there. But I would say for a lot of people getting into that kind of high fours, low fives, is attainable.
What about for our commercial friends? Everyone's making the jump. Everyone wants to get into buildings now. CMHC, but save that for last so that
Yeah.
people can salivate about that. Just standard, and it's not even that good
Yeah.
to salivate about. That's the sad thing when you're going to say it.
Everybody does, though.
But okay, that standard commercial rate. Where are we modeling out now?
Again, like really broad
Yeah,
lender to lender. So we're seeing so commercial, again, let's just define that a little bit better for the viewer. So we're talking commercial multifamily, so
Yep.
larger multifamily properties. On stabilized conventional, we're seeing kind of high fives, low sixes,
Okay.
again, depending on the lender. I'll preface that with that probably comprises 1% of our book. We don't do a lot of that. That's usually not the choice approach.
Yeah.
The project lenders, which I think a lot of people in the multifamily space are interested in, these are the lenders that are helping you with an acquisition of a building that needs some work, helping you with kind of going through a project. They're running right now around between prime +2, prime +3, give or take. So we're talking like high 8s to high 9s.
Wow.
And then CMHC rates, again, very dependent on the mortgage size and location. I've seen stuff as low as the high 3s. And
Amortization?
For that one was a 50-year amortization.
I'm sorry.
Sorry, did I jump to the salivating part?
Sorry. Okay, keep going. I'll let the dagger hit.
As high as 5.
As high as 5.
So it just kind of, again,
As high as 5. That's still good.
Yeah, it's still great, but that kind of band between like 4 to 5 roughly for the CMHC stuff right now is where it's at. CMHC just came out with some really interesting decisions.
Okay.
Some of which I think we were all kind of waiting for, and some of which we were all waiting for, but they didn't give a lot of clarity. So the two big pieces of news in CMHC right now for those that haven't read about this yet is two big changes. Number one is they're increasing their insurance premiums, right? And sorry, to preface for all the viewers, I'm talking specifically about multifamily CMHC commercial grade apartment building product, not average home buyer looking to put 5 or 10% down on their first purchase.
They're still okay.
That isn't changing whatsoever. All of that, again, there's talk, but there's nothing formal as to any changes there. So, but in the commercial multifamily space, they're raising the premiums on both their, we'll call it the old product, the standard CMHC mortgage product, as well as their MLI product.
Okay. They're finally fixing that MLI that everyone's waiting in line for.
Yeah. So they're going up, they're going up, I think it's, I'd have to double check, but I think it's about 80 points on the traditional product and 160 points on the MLI product. So those that were getting a 1% premium, that's going to move to 2.6, something in that range. So not a huge stretch of the imagination that they want to do that. I mean, the insurance premiums that were being paid on mortgages that are at 95% loan to value with 50-year amortizations and no personal recourse, like that was kind of insane that you were paying a 1% insurance premium for the life of that loan over 50 years.
Yeah.
But the more challenging change to interpret is that they have said that they're going to take more prudent and conservative approach to approvals, which basically means here's our policy, right? If you have XYZ, you can have a 40-year amortization and up to this loan to value, and you're capping out at this debt service ratio on MLI, different set of requirements. We're not going to actually change the policy, right? We're not going to say, hey, you used to be able to do 85%, now you're going to be at 80. Hey, you used to be able to do 95%, now you're going to be at 90. Or shorten the amortizations or increase the debt service requirements. But they're just broadly saying that they're going to take a more conservative and prudent approach to the process, which means that in a way, we are expecting that CMHC is not necessarily going to provide the maximum potential approval in every case.
Okay.
Right. And
how long is it going to take to find that out, though, knowing that sometimes that process with them is a little longer if you're someone trying to build
it's
out
really
a deal,
challenging,
right? Like
right?
How do you build a conditional period on a deal contingent on, or even factor out your investors or anything else like that?
And the problem with this isn't even about the conditional period. I mean, I would say when we're trading big assets, big assets are typically trading direct to CMHC. Right. So if I have my $10 million apartment building and, Joe's going to buy the $10 million apartment building from me, he's probably going to assume I probably already got some CMHC financing in place. Okay. He's probably going to assume that maybe he does a peri passu top up or something like that to get a little bit of extra leverage there. Um, the scarier part is on the projects, right? People are going in to buy these buildings or convert commercial space, residential space, or they're doing something where like we're not starting with CMHC.
Mm-hmm.
CMHC is going to be the route that we take a year down the road, 2 years down the road, 3 years down the road, right? So then the question becomes when you're looking at that ARV, when you're looking at what is my final mortgage amount going to look like based on my projections, how much
Yeah.
capital am I going to recapture?
Yeah.
It's not having a deep understanding of where those lines are going to be drawn.
Yeah.
Right. And one of the things that I love about what I do, and I love about both residential and to a degree commercial lending, is that from an analytics basis, we can do a really good job of before we submit a deal, whether it's CMHC or just a traditional residential mortgage, and we know where our approval is going to stand with a pretty high degree of certainty in most cases, right? It's
Mm-hmm.
it's very mathematical. We know where the debt servicing ratios are. We know where the debt coverage ratio is for commercial property, so we can say, oh yeah, we think you're going to get X, Y, Z. As soon as lenders start bringing in, or I should say in this case insurers, they start bringing in policies that are ambiguous,
Mm-hmm.
it makes it a lot more challenging for us to help people understand the certainty, right?
Yeah.
It makes it challenging for us to pinpoint and say, here's what I think your outcome is going to look like.
Mm-hmm.
I'd almost rather you change a policy, scale back on your policy, set a set of guidelines that says, hey guys, we're reducing LTV, or we're increasing debt service requirements, as opposed to just being very vague about saying we're going to take a more conservative approach.
Yeah. Lots of things changing, as there always is out there in the market. I guess for any of you at home wondering, I'm curious to know what you're thinking. Have we hit the bottom? Has this the bottom of pricing? What things are going to change? How are things going to change? What are we going to see with prices and rates? And how are you making bets? And what are you betting on? But for today, you can bet on us. Wrapping this up right now, I'd like to thank David Giustizia for joining us from Vision Capital Partners here today to talk to us all about what's going on with rates and with the real estate market out there. Thank you for viewing. Thank you for tuning in. I think this is one of those times where I'm supposed to say, make sure to like, subscribe, and follow, and do the rest of it. And until next time, see you later.
Awesome. Thanks so much for having me, Mike.